Hello there. Well, South Africa's finance minister has just delivered his medium-term budget policy statement. And of course, what we did here in the budget policy statement, which is a very important piece of South Africa's budgeting process, is that the minister did warn that South Africans spend more than we earn. He asked how we fix it. He answered this by saying that to stabilize debt, government would target a primary balance by 2022-2023. And the target measure excludes support to Eskom because that is the part of a separate process. He also said that government will deal with the wage bill among other measures. But will it be enough to stave off a Moody's downgrade on Friday? And to find out more, I am joined by Abex's Rashad Tayob. Rashad, just looking at the market's reaction to the budget. In fact, as the finance minister was talking, I saw the rand moving in the wrong direction. What is this an indication of, with the currency almost 2% weaker against all the major crosses, the euro, the dollar and the pound?
Yeah, the markets reacted quite negatively. The rand was about 14.60 up at about 14.90 now. Bond yields have moved up about 20 basis points. So the 10-year just prior to the budget was sitting around 8.90. It's now about 9.10. So definitely a negative reaction to Tito Mboweni's very realistic budget forecasts. If you look at the numbers, they're not totally out of line with what economists were forecasting, but it's a massive deterioration where early in the year, we were expecting budget deficits of close to 4%. We're now seeing budget deficits above 6% for the next few years. Debt to GDP was supposed to flatline at around 60. We're now hitting 60 as near as February 2020, with a likelihood that we're going to be up at 70% debt to GDP ratio by the time we get to 22-23. So this dose of reality, the market's not very happy, having looked at the forecasts.
The trade is saying right now, they're saying that Moody's come Friday, there's no way they can't either one change the outlook or downgrade South Africa to junk status. And of course, Moody's is not the only risk here, because what about S&P? What about Fitch? What do they do?
Yeah. So obviously Moody's is the main one because it's quite imminent. They've been quite lenient on us. They've always set red lines for us. We've gone over those red lines, but they've allowed us to remain on investment grade. But I think why the market is a bit shaken at the moment is because this might be the last straw that breaks the back. And they say, we cannot keep you on a stable outlook. We have to put you on negative outlook, and inevitably that will result in a downgrade by early next year. So that's why there's a bit of positioning, because I think if we had tried to sugarcoat it with better growth assumptions, better growth revenue assumptions, it may have bought us some time, but that's not really Tito's style. Tito's quite a resolute character. You've seen that when he was governor of the Reserve Bank. He's decided to show the reality of the finances and show the reality of South Africa's fiscal position, and inevitably that will result in a downgrade to sub-investment grade. Fitch has us on negative outlook, so we're already one notch below investment grade. They're likely to take us to 2 notches below investment grade based on what we've seen today.
I mean, he started quite poetically with the aloe ferrex plant, talking about the resistance of that plant and juxtaposing it to the South African economy, touching on the fact that, I mean, we have lost around 10 years in terms of growth, but that if we implement some of the things that are in this budget and also in his Treasury's recently published growth plans, that we could be turning the corner. I don't know, as the market, are you as optimistic that all it takes is implementation at this stage or not?
So in order to get us back to sustainability, we need one of two things. We need to either cut that deficit, either by getting more revenue or cutting spending. The revenue is tapped out, so that's not an option. We need to either cut spending or get this economy growing at 2.5% to 3% again. That's the only way we don't fall off a fiscal cliff in the next 2 or 3 years. Now, how do you get the economy growing? I think that Treasury has done a lot in terms of, on the sidelines, pushing their economic plans and trying to get it at the forefront of ANC policies. To date, unfortunately, we haven't really seen evidence of anything getting implemented. So while he's talked a lot about where we can invest in technology and spectrum, at the end of the day, we've been waiting for spectrum for 3 years, and it's always 2 years away. So I think the market is tired of plans. And while Treasury has some good ideas, we need to see evidence that they're actually being implemented at this point.
Well, Rashad, thanks so much. Let us leave it there. Of course, the market being really tired of ideas. And in fact, the finance minister starting off by looking at what has happened in South Africa over the past 25 years, talking about the fact that in the past 25 years, the livelihoods of South Africans have only improved by around 1 times. And him just juxtaposing this to what has happened in China, where your average Chinese citizen is 7 times better off than they were 25 years ago. Your average Indian is about 6 times better off than they were 25 years ago. Not the same case in South Africa, and the finance minister being honest to say that mainly policy missteps is the result why we are not doing a lot better. But let us continue to unpack that midterm budget that has just been delivered by National Treasury in the form of the finance minister. And joining me at the desk now for more is Lulu Krugel, who is the chief economist and director at PwC South Africa, College of Business and Economics at UJ, and Canback Consulting's Arshad Abba. And thanks so much for joining us. So by way of introduction, your initial impressions of the budget, Lulu, beginning with you.
Well, I suppose we knew it wasn't going to be a pretty picture, but it's still shocking to actually see the reality and to see how much things have actually changed since February this year. I think even in February we were saying to each other, there's no way we're going to get close to that 4% deficit. We're definitely going to breach 5%, but actually seeing 6% there in the numbers, that's a bit of cold water in the face. So, but on the positive side, the minister did not try and paint a more favourable picture. He was clear, he was direct, and he was very, very urgent in his message to say, if we don't change the way in which we do things dramatically, if we don't change the policy direction and the trajectory of the economy, we're going to be in serious trouble in a couple of years' time.
I don't know about you, but I feel like I've heard that before. If we don't change, we're going to be in trouble, and yet we continue to not do the things that we need to do. Your impressions of the budget?
I think the numbers are quite disturbing. I mean, the numbers, not only what we see currently, but also the numbers for the future. What is positive for me is the acknowledgement from government that we actually have a problem. And that's a big step forward to actually acknowledge that we have a problem. He focused on the wage bill. It's something that we need to address urgently. He focused on SOE spending, and he said, well, growth is not going to come, but we have to find structural ways of making it come. So I think the positives are acknowledgement from government that we have to do something. What is not clear is how do we go forward?
Yes.
But we just cannot go on the way we are.
Yes, I mean, it looks like the market is not focusing on the positives at all. In fact, I almost lost my breath when I heard the projection for the debt to GDP ratio being at 70%. I mean, already at the current 60, we're way above our emerging market peers with the same category. With 70%, how does a ratings agency like Moody's not act tougher on South Africa?
That's the thing. If Moody's don't make a decision, at least to put us on a negative outlook and potentially downgrade us early next year, they will lose face. Because if you compare us to, as you rightfully say, our emerging market peers, we're already way in the red. So as Rashad has said, that red line that they've put in the sand for us, they kept on moving it, and they kept on giving us more grace. But at the moment, I see it's very, very difficult for government to actually change their mind around it. I know they are having a conversation with Moody's as we speak, to explain to them what the plans have been, but the challenge is up to now, every single year we've missed our revenue growth targets, we've missed the GDP growth targets, we've missed the targets that we've set to ourselves to cut back on spending. So after a while then, it's very hard to believe the policy implementers if that continues to be the case.
Because right now, I mean, the conversations that government is having with Moody's behind closed doors, is this a conversation around, please just change our outlook if you're going to move, or can Moody's still save face by just changing the outlook and not slashing us to junk status completely?
I think Moody's will make the one step down on Friday to negative, which essentially signals that we're getting to junk status. I think getting to junk status by end of the year, early next year is definitely on the cards. The probability is definitely higher, and effectively that will impact our debt servicing cost. So I think the reality is now hit home. The question is, hopefully this will help government actually implement what they're saying, because that's the area we've never had clarity. We've got policy uncertainty. We've got no clarity in terms of making business easier to bring in investment. And those are the things that need to be fixed and can be fixed quickly. but it needs commitment from government to move forward.
How concerned are you about how other ratings agencies are going to react to this, or does it not matter what an S&P or Fitch does at this stage because they've already got us on junk status?
Well, I suppose if you look at us being included or excluded in some of the bond indices, that wouldn't change. But obviously, if we are already on junk status, but if they downgrade us further, it is just so much more difficult to get back to that investment grade, first of all. And it also sends a signal to the market to say that, hey, things aren't improving. They're also not staying the same. It's actually getting worse. So it's not a position that we want to be in, actually. I think we would prefer to stay that one notch below thing if we have to, and then work our way up as quickly as possible to retaining our investment grade.
But then, of course, I have also heard the view that it's not all doom and gloom should we be junk status by all margins. I mean, that there's still investors who would be willing to put money in a country that is of speculative investment grade.
Yes, but I mean, investor sentiment in general would be down. And I think what we want is we want the big investors to come to the market and to support us. And I think convincing them once we go that one or two notches down that we are doing the right things in the longer term. I think in the past we had South Africa as effectively the flagship of Africa. The other economies, specifically Egypt and Kenya, actually standing up with growth above 6%. And essentially there is competition for gateways into Africa that is not South Africa. So we're playing in a more competitive environment, and we have a harder investor to convince to bet us rather than betting other economies within the continent.
I mean, ultimately, I think walking into this budget, it was all about Eskom and what would be announced regarding Eskom and the way forward and other SOEs. What do you make about some of the announcements coming from the finance minister regarding Eskom? Lulu, before I add my 2 cents.
So I think what is a little bit disappointing for me is that we had to wait until now to actually get an answer. In February, in the budget speech, they already mentioned that by March there would be some kind of plan on the table. So the plan that we saw released yesterday, I was hoping to actually see in March. There wasn't anything that wasn't already kind of speculated about in the market and that we weren't expecting. They have set themselves a couple of stretch targets, so to have the boards for the 3 entities in place by March of next year. If they can do that, I think that would already send a good signal that they're moving in the right direction. But if you look at, for example, the list of criteria that they've put forward to Eskom to say, listen, you need to adhere to X, Y, and Z in terms of the money that we've provided you. I almost feel that these are things that should have been done in any event. You know, it's not things that are now out of the ordinary, and that's things that you would have expected from an SOE that was prudently managed. So I'm still a little bit, I'll have to see how this plays out. Yeah.
Because, I mean, the minister emphasizing the fact that, I mean, if the support that has already been given to Eskom by way of a 230 billion rand over the next 10 years, rather, that will be broken down. If the support is not enough, Eskom, you are going to get support from us as government, but it's going to be through a loan, which you'll have to pay interest for. I'm like, if I can't afford to pay back that loan and that interest, then what? I mean, is this a positive sign by dealing with the issue of SOE bailouts, or is it just more of the same?
I think the one thing that concerns me even before that is he put certain conditions that we have to meet our targets in terms of how we break up the entity. And if we don't meet those targets, there will be further burden or strain on the fiscus. Right?
Sure.
So I think let's first look at that point. So I think we need clarity on that of how sustainable is this plan and are we able to meet our targets? Because we obviously have a very strange fiscus and we want to manage around that. The other thing is, I mean, until we come to a point where Eskom becomes sustainable, it will be very difficult. I think the positives coming out is that they're looking to clean up houses. So they'll take out all the fringe benefits and all the additional benefits, which will lower some of the costs. They look at the wage bill, bringing the wage bill down, and try and work through that. So I think there is some positive steps, but strategic direction, I think that's just taking too long, and we have to sort that out.
I mean, on terms of bringing the wage bill down, if I can just get to it, and this is something that I think, or you can comment as panelists as to whether this is a positive or not. I mean, freezing the salaries of cabinet members, MECs, and premiers. Of course, the finance minister also alluding to the same action, or suggesting the same action should be taken by Parliament, setting a cap on how expensive your car can be, or what your cell phone bill can can be, and also boohoo, no more flying in first class and all that. But on the other side of that statement was the fact that the savings measures that were announced in the February budget by way of asking public servants to resign, essentially voluntarily resign. Yeah, that's not yielding the results.
No. So there was definitely not the impact from that they've hoped for. I can't remember what the exact number was, but it was a fraction.
I would think around 4,000,
yeah,
but don't quote me.
It was a fraction of what they actually, I think they were hoping for about 30, and it ended up, as you say, in the region of about 4,000. So missed that target heavily. These kinds of symbolic actions we've seen for some time now, actually. If you think back to the time of Minister Pravin Gordhan, actually, some of these were already announced then. But for me, it still doesn't deal with the size of government, you know, that just the overall wage bill, that bloatedness of it. So I still feel that these are, it's important signals, but it's not the hard enough steps yet. And he mentioned there, you know, suggested to the SOEs, maybe you want to follow suit. And I also heard from one of my colleagues that was actually there beforehand in one of the media discussions that one of the suggestions that they made to the state departments is to say, government departments, is cut your expenditure by 5%. We ask you to please do that. And at the end of the day, they came back with 2%. You know, so it feels to me like it's still not, you know, been taken seriously enough yet to really cut back on the spending.
And not even cut back on expenditure. I mean, we read all the time about how there's a regular expenditure, and sometimes how these government or certain government entities don't even spend the money that is allocated. So there's underspending and spending that could otherwise go towards infrastructure and social development.
I think they have to make sure that they plan better in terms of how they get the spending in areas needed like infrastructure, housing and schooling. And they have to also be open with labor in terms of future salary increases, because if you look at the national wage bill, grew at 66% over the last 10 years. If you look at the private sector, I mean, in most companies today that we evaluate and we work with, they grew their salaries either way below inflation to account for that. And how they balance that is the lower end of the employees, the lower earners actually earn the higher percentage closer to inflation, where the top end earn less. And what we're hearing from government, for example, in some instances, we're making 13-14% for executive management increases in some of the councils, and then we're telling our normal day-to-day workers that you should earn about 4 to 5% increases. So I think prudentially getting this right and not being scared to actually take salary cuts because it's necessary because we've grown too quickly are quite important steps. But definitely spending on infrastructure, planning properly on how we're spending on infrastructure is important to support growth if it does come.
We'll talk about that infrastructure planning and the suggestion of blended finance to fund that infrastructure fund. But let's take a look at how the rand is reacting. I mean, walking into this budget, it was almost a done deal that it would be bad, and therefore we wouldn't have that much of an impact in the currency market. But clearly, investors didn't think it would be as bad as the numbers that we have heard. I mean, at lunchtime on Power Lunch, the rand was trading at around 14.60. It has now lost 2%. It is trading at 14.92. So we're just looking at that 15 rand to the dollar mark, and of course the rand is a lot weaker against all the other major crosses, the euro, the pound. I'd just like to bring it back to the proposals that the finance minister did try to put on the table to say that maybe this is how we can get a little bit more extra monies by way of, you know, the freezing of the public sector wages. Haven't we been here before? I mean, didn't a board try to do that with Eskom? In fact, the previous CEO, Phakamani Khabane, when he went in there, he said, okay, no increases, and how look how that worked out. They ended up getting increases, right? So how confident are you that, you know, government workers are going to take this lying down?
Not at all, actually. If you think about the history, as you've said, it's clearly something that that is not. It's very unlikely to happen, especially to the extent that we need it. And I think that's a challenge at this point in time for government, broader than just you know, the salary increases, etc., is that the tripartite alliance within the ANC and the role that the trade unions still play there as well. And, you know, that pulling in different directions. Even if you look at the growth plan that the minister put on the table in August, he said today that, you know, we've put it on the table and it's there, but now it needs to be debated. And to be quite honest, I understand that we live in a democracy, and I think we all want to see that. But there's certain times where I just think there shouldn't be debate about things, and it's about sitting around the table and saying, guys, that's where we are. So either you all lose your jobs, or we do something to try and stabilize the ship. And here's some of the plans that we have on the table. If we need, for example, at Eskom to retrain some of the people to get involved in the renewable energy sector where there's demand, for example, or whatever plans. But we can't have the stalemates anymore where we can't move forward and implement some of these things as a result of these tensions.
No, for sure. And just to talk about that infrastructure fund, because they say infrastructure being the backbone of economic growth, the proposal to introduce blended finance to finance this. Sorry to sound so downbeat. Please come up with a more optimistic view of, this can possibly work, and this can potentially be one of the facets that we need to get this economy growing.
I mean, if you look at some of the structural changes that have happened in some of the other economies, they've done well because they focus on infrastructure spend. Yeah. They've spent before the income or the growth came through. And I think that's a positive in terms of what we're looking at. But also we have to be very careful, because one thing is putting the money down, the other thing is spending it correctly. I mean, if you look at our education system, we've changed our forms of education so many times over the last year. I think our poor kids are confused these days. I mean, you don't know what they're learning, the curriculum changes all the time. So we need some stability in terms of how we go forward. But like you said, I mean, we have to invest behind certain core infrastructure of the country to bring in tourism, to bring in agriculture, and to make sure we're able to push our products not only in South Africa, but across the African continent. The other thing is, how do we work closely with our partners in Africa and other emerging markets, because we never mention other emerging markets. And how we go forward is quite important. So building those relationships, but we need that infrastructure, because the only time confidence will come back is if we've got the infrastructure that's not creaking and breaking down like we're seeing with load shedding right now.
No, for sure. I mean, mentioning the other partners, he did refer to the growth rates that other countries on the continent are experiencing. Ghana is expected to grow at 7.5% this year, Ethiopia 7%, Kenya 6%, South Africa 0.5%, if we even get that. The investment conference is next week. Does this budget paint a picture or an environment in which companies can lay down their money and say that, yes, we believe that there will be a turnaround eventually?
I think the one positive that we have playing in our advantage at the moment is the fact that the rest of the world is looking for opportunities to invest. They need to find places to actually, take their money to. So Africa is definitely on the cards again there. We're talking to private sector investors that's looking for opportunities in big infrastructure projects, and that's really looking for places to take their money to get the growth. So that's the benefit that we have. But as you've mentioned now as well, our neighbors are really outshining us a little bit at the moment.
A little bit. I was about to say, why come to a 0.5% growth region when I can get 6, 7, 8%?
Yeah, I mean, that's quite interesting. I think the thing is, investors will go where they get the right return for risk. And investors are not scared to take on that return for risk. And we need to make sure that we make it attractive enough to actually give them the returns they're looking for. I think positively, our income per capita in South Africa is significantly higher than Ghana and Kenya. Secondly, I think infrastructure, we're a lot way down the way in terms of where they are right now. But the challenge is they're catching up quickly. I mean, our middle class is not growing, theirs is growing. We're actually going in the opposite direction. We've got large companies that feed into Africa, but we're too scared to support our neighbors. Whereas they've got emerging companies starting to evolve and develop across the continent. So I think we've got some headroom in terms of past development, but they're catching up very quickly.